Hello and welcome back to the most recent edition of the Short Vol Show. I am your host, David Lincoln, and I'm happy to be here on a Saturday morning, which is a little bit rare, but the reason I'm here is because yesterday I had to do a side job in the morning, so I couldn't come on, so I figured I would make it up today. So what I wanted to talk about is we had a couple questions from viewers, and a lot about trading is repetition, and thus a lot about what I talk about will be repetition because that is sort of the cycle of life. We get up every morning, we make our bed, and we get going, and thus I don't feel like there's anything wrong with repetition because it's going to reinforce ideas for people. We got a couple questions lately, and I want to address a couple of them. One of the first ones I want to address is what is TVIX and how does TVIX work? A lot of people, they're just kind of browsing through maybe stock twits and they see TVIX, they see it talked about, and they hear about people having huge returns on it, and then they watch it trade, and it's kind of hard to figure out if you don't know what it is. So let's go through for a second what TVIX is, just basically for a review for people. TVIX is a volatility-related ETP. It's actually an ETN, exchange-traded note, and it is administered by a company called Velocity Shares, and it is based on trying to achieve a return of 2 times the movement of a mixture of VIX futures on a daily basis. So if the current mix of VIX futures representing 30 days out on the VIX, if that mix of futures on any given day is up, say, 25 cents, then TVIX aims to be up 50 cents. If that mix of futures is down 25 cents, TVIX aims to be down 50 cents. So whatever the futures do, TVIX aims to do twice that. Now, the one thing that's always confuses people is that they look at the VIX and they say, why, the VIX is up 50 cents, TVIX is not up $1. And that basically is quickly explained by saying, look, TVIX is not based on the VIX, it's based on the VIX futures. And the VIX futures don't always do the same thing as the VIX does. More on that later. That is basically the premise of my entire show, is to kind of describe what the VIX futures do and how they relate to the VIX. It has to do with the VIX term structure. But in just basic terms, TVIX is based on the VIX futures. And so, and to kind of extend the whole explanation out further, the VIX futures are based loosely on the VIX, and the VIX is a number. You can't actually trade the VIX. It's a number that is derived from a formula, and the formula takes into account prices of a strip of SPX puts. So SPX, a major index, equity index of stocks in the U.S. Puts are options that allow people to guarantee a certain price that they could sell this index at. Generally, people buy puts for protection if things go wrong and the index goes lower. If you buy, say, a 2,500 level put, then no matter how low the index goes, you can sell the index at 2,500. So most of the people trading the SPX puts would be in size would be fund managers. A typical equity fund buys all of these stocks in the S&P 500, and part of the money that they're hoping to get when they buy these stocks comes from dividends. So every many stocks pay out dividends over time, and so if you own the stock, you collect the dividend, and that adds to the total return. Your contention is that stocks will move higher, plus you get the added bonus of getting a little income from the dividend. So when things kind of don't look so great, instead of selling out the stocks and losing the chance to get that dividend, because the dividend is going to, dividend can be paid even when the stocks are down. So instead of selling the stocks and foregoing that dividend, fund managers might buy puts on the S&P 500, the SPX, and as a hedge against their positions. They're being long the SPX. So where does TVIX? So let's go back and move that back towards TVIX now. So the more puts people buy in the SPX, the higher the prices of those puts go relative to the SPX price, and thus the VIX goes up. So if the VIX is 16 and the market starts to go down, people start to buy SPX puts, the VIX might move to 17 or 18. And as the VIX moves up, the futures that follow it, the VIX futures, will move up, and TVIX will move up too. So, and TVIX will move up 2 times what the futures move. So thus, if the market, say, crashes tomorrow, TVIX could really spike upward. So we were in a situation in February and March where, because of the nature of the where the VIX term structure was and the way the futures were, it was a great trade to buy TVIX when nothing was going on and just kind of hang out, wait around for something to happen. And a lot was happening in February and March. A lot was happening in political world, global politics. I don't like when people say, well, today, everything's worse than it ever was, and today is the most important day ever, because people say that every day. But so let's just even in just sort of, let's say, an average period, if the term structure is flat, which it was in February and March mostly, if you were to buy TVIX, when nothing's really going on, you could buy it and just hold it until, quote unquote, something happens, whether it be President Trump tweets something, global politics, someone misses earnings, and the TVIX would pop, and then you could sell out your shares and make a nice profit. However, that situation where it made sense to buy TVIX because of the term structure being a certain way, that doesn't last. The term structure is generally about 80% to 85% of the time is in what's called contango. That means that the futures curve is sloping up. And when it's in contango, buying TVIX and waiting is much more of a crapshoot, because TVIX slowly decays over time when the term structure is in contango, and thus you need to time it just right to make money owning TVIX. Otherwise, it's just going to slowly walk down. And if we pull up some charts here, I can illustrate that with a chart. So let's do that real quick here. So let's pull up a TVIX chart here. And you will see, if I pull up a 1-year chart, you can see it just sort of going straight down. Let's get my big noggin out of the way here, because I don't mean to block the whole screen. All right, so I can make myself a lot smaller here. There we go. Move the screen up a little bit, and perfect. Okay, so we see TVIX we'll move this up even more here. So we see TVIX over time going down. That's a year chart. If we go to a 3-year chart, you're going to see it even more. Your TVIX just going straight down. So a lot of people online will tell you, buy some TVIX. It's a great shot. If the market crashes or something bad happens, you're going to clean up. You can bet $1 and win 10. The only problem with that is that like other situations where you're betting $1 to win 10, say like, I don't know, a scratch ticket maybe, most of the time you're not going to win. Most of the time your money's going to go away. And it's just that one random time that you actually time it right that you'll make money. For people who want to consistently make money in the markets, we want the opposite situation where most of the time we're making some money. It may not be 10 to 1. It may not even be 2 to 1. It may be like 10% per month would be great. Something like that. And so for those of us who want to make money consistently, we are going to actually take the other side of that trade and we're going to say, okay, 90% of the time I'm going to collect money, and that one time that stuff spikes, I'm going to somehow I'm going to try to hedge myself against problems with that, or I'm going to put a position on that is not going to get too destroyed if we do have a spike. And so when someone says, should I buy TVIX? I say to them, all right, let's look at the term structure. And if the term structure is in contango, I warn against it. So let's go. So say you came to me today and said, I want to buy TVIX. So the first thing I would do is I'd type in VIX Central into my browser, and I'd pull up the term structure. So let's do that now together. And we can see here that the curve slopes upward as we go from June towards January. So that means that the curve is in contango. And if we look to the bottom, we can see it says contango number 1, 4.4%. That means that VIX, the futures or the VIX ETPs, TVIX is decaying or losing value. I like to say losing value because it's a little bit more complicated than just saying, well, it will be down X amount this month, because volatility is always moving and things are moving around and the rate of contango is moving around. So it will lose value of 4% per month. And thus, now, that might be something you're willing to live with. If you do the math, 4% per month is only somewhere around 0.15% per day. So pretty, not, with this type of contango, 4%, it's not really overwhelmingly decaying. I mean, it's almost, it's right on the border of being negligible. So, but it is decaying, and it could go lower. Now, also, when we're in contango, generally, it means there's calm markets, and if nothing happens, the VIX could go down, and that could add to the amount that TVIX goes down, because TVIX, the main components of TVIX going up and down are just the VIX moving higher or lower, and the future is responding to that. Contango or backwardation affect it in a small way, but a significant way over time. And as traders, we're trading stuff over time. We're not as interested in what happens just today, because then tomorrow comes and we have to deal with that, and the next day and the next day. So if I were to look and see 4% contango, and then the other thing I might want to look at if deciding whether to buy TVIX or not would be, where is volatility historically? Where is the VIX compared with where it has been in the past over time? And that's a super important thing, not only for someone trading TVIX, but for any sort of options trader. Really, historical volatility is super important. So let's look at the VIX here. VIX currently 13.22. Now, I can tell you that the average volatility of the VIX over, the last 10 years, let's say, 20 years, is around 17, 18. So we're already lower than the average for the VIX. However, last year the average of the VIX was much lower. I don't have the number exactly in my head, but I believe it was somewhere around 11. So the VIX kind of in a mid-range, but to the low side right now. So keep that in mind. And the other thing I would kind of look at is what's the trend right now in the VIX. So if I pull up a VIX chart for, let's say, the last 20 days. So here's the chart for the last 20 days. What's the trend look like to you? To me, it looks like it's going down. So if the trend continues and the VIX goes lower, then TVIX will go lower as well. So we've got contango going against us, and we've got the trend on the VIX right now going against us. Let's look at a different time frame just to kind of check it out. So in 1 year, if you look at the 1 year time frame, however, it kind of looks like that's the TVIX one. Hold on one second. I'm not synced up right here. So here's the 1 year. And you can see, well, it had that huge spike in February. And before that, you can see we were trading in a lower range than now. So if I look at that chart of the year in the VIX to decide whether this is a good point to buy something like TVIX, it's kind of inconclusive to me. I can see we're trending down. It looks like sort of the bottom is 8, right? 856 was the low there. It looks like if we got to 9 around there, that would be a great place to buy, because it doesn't look like it actually is never going lower than that. That's actually the all-time low, 8.56 there that you see. But if I could easily see the trend continuing down here to reach that from 13 down to 8, and if that happened and you were long TVIX, it could be crushing to you. So now we're armed with a few pieces of information. We know where the VIX was, where the VIX has come from. We know the shape of the VIX term structure, and that we are in contango, so we're losing 4% per month. That's going against us if we're long these. And we know where historically in the range of the VIX we are. We're kind of on the lower side in the VIX range, but not at the bottom. The bottom would be 9% maybe, or not maybe. The bottom would be 9%. However, we are trending lower. So armed with that information, I have a little bit better of a case to decide whether I want to get long a TVIX or not. And it's unclear right here. It's not a screaming buy to me. It's not a screaming sale to me. So that is a brief look at TVIX. I was answering a specific question. Let me pull up the StockTwits question, which I was responding to here for you folks. See if that's going to help. Let's see. Stay with me. So, and we get this question all the time, which is fine. All right, here we go. So let me pull this up for you. So this was the question I was referring to by Stock Trader 86. And he said, TVIX, okay, I'm still trying to understand this stock. Can someone simply explain it? Pull web, I just see a roller coaster and a bunch of BS. Okay, so hopefully I gave you a little bit more of an understanding of TVIX being a double leveraged VIX ETP. It's specifically an exchange traded note administered by Velocity Shares. And it seeks to perform twice the performance of a combination of two VIX futures, which average to represent 30 days out for the VIX. So basically approximating the VIX using futures, but not actually the VIX. And because it's not actually the VIX, which you can't trade directly, it is not going to behave 2 times the VIX on any given day. Sometimes it will behave better, sometimes it will behave worse. But for people to say, oh, this is manipulation or a scam, this is traded based on a formula. Unlike actively traded ETPs, this is traded by a formula. There's no wiggle room for quote-unquote manipulation by the fund management. It's traded very incredibly accurately based on the formula, and so it will correspond exactly to 2 times or very close to 2 times the movement in the futures every day. The people that are saying it's manipulated most likely just don't understand what this actual vehicle is. Okay, so I want to move on to UVXY now. Now, UVXY was very similar to TVIX for a long time until in February of this year, when in response to the huge move we had in volatility and the acceleration and closing of the fund XIV, ProShares, who administer UVXY and SVXY, decided to deleverage their fund. So they had SVXY, which is essentially the opposite of TVIX. When volatility goes up, SVXY goes down, and SVXY was 2 times. Actually, I'm not sure if it was 2 times or 1 times leverage, but either way, SVXY was delevered down to 0.5 times the movement of the VIX futures in 30-day averaging. UVXY was exactly like TVIX. It was 2 times leverage of the VIX futures. So it was exactly like TVIX, and what they did is they delevered it down to 1.5 times the futures. And the main difference between TVIX and UVXY is that UVXY you can trade options on, and SVXY you can trade options on as well. So that gives you much more powerful tools to trade UVXY than TVIX. In general, people who are trading TVIX long term, many people short it, and so they short it and they take advantage of the decay effects of contango over time. When they get a spike, they just sort of weather the storm, and they know that it's going to continue to go lower over time. UVXY, many people short that as well. The problem with shorting both of these is that they are hard to borrow. So I won't go into total detail of how shorting works, but essentially you need shares if you want to short something. And both of these are hard to borrow. That means that you do have, you incur buy-in risk if you short them. So you essentially, if you want to short one of these, your brokerage borrows stock from someone else to short, and if that stock happens to get called away from them, then they have to take your short off. So you could come in one day, and at noontime, they say, oh, guess what? You're no longer short this. And that can be very troubling, and especially if your short is against some sort of long other position, you can find yourself all of a sudden long volatility out of nowhere. And so that is a risk you incur to short it. So the other question I wanted to address today is, what's the best way right now to make money in UVXY? And for that, let's go to the chart. Now, remember with options, you can do pretty much, you can take any sort of risk you want, or you can customize your trade for what you think will happen exactly. So, for example, if I thought that UVXY, well, let's just use just a random stock. If I thought Amazon, for example, was going to go to 1,700 and just sit there for the next year, there is a trade I could put on that would maximize my profitability if that happened. If I thought Amazon was going to go straight down, there's an options trade for that too that I could make money on. If I thought Amazon was going to go from 1610 down to 1575, and sit there, there's an options trade for that. If I thought that Amazon was going to bounce back and forth between 1,500 and 1,700 for the next 6 months and be just move back and forth all over the place, there's an options trade for that. So we can design the perfect options trade for our view of the future in a stock or an ETP. So with UVXY, let's take a look at the chart of it in the past. And I've never really been a fan of strictly totally relying on the chart from the past to determine hopefully what's going to happen in the future. The other thing is that I was taught to not use hope in my vocabulary at all as a trader. But if we were to look at this, if we were to look at the chart for, like, let's say 180 days here, we see a huge spike in February and then slowly going lower over time. And so probably a good trade to have on if that were to continue would be to be slightly short UVXY and maybe be short some options so that you're collecting dollars. If things don't move that fast, now that it's been delevered, there's going to be less action. So if things don't move that fast, if you're short options, then you're collecting money every day. And it's a nice thing to be doing if nothing's going on, collecting money every day. If UVXY were a stock, it would be considered, I think, to have a very high volatility level to it. So remember, the VIX right now around 13. That means, and your average stock maybe having a little bit higher volatility than that. But UVXY right now, volatilities are up around, right around 100. So generally speaking, in the stock world, being able to sell 100 vol sounds like a really good thing. Now that you can't totally judge it on that, but it seems like a better volatility sale than a buy just based on comparing it to other products in the financial world. Now that might not be the best way to analyze things in general, but just to make the point that it is a high vol compared with if you looked at $11 stocks and equities in the equity market. So from my point of view, one of the best ways to trade UVXY now would be to be a little bit short it, but be careful not to be paying too much to be shorted day to day or collecting some money to be shorted day to day without having too much risk. Now, the risk in here is usually and continues to be that of something really bad happening in the stock market and this spiking to the upside. If it goes lower, and as it goes lower, it's not going violently lower, it's going slowly lower. And so generally to the downside, there's not a fear that this is going to drop from 11 to 5 tomorrow or something, let's say. But it would not be inconceivable that this UVXY went from 11 to 20 tomorrow if something really bad happens, some sort of black swan event. So we want to make trades that we collect money as it goes down, whereas limiting our risk for a big spike. And the way I've been doing that lately is by using spreads in the options, because spreads are defined risk trades. So you know how much you can lose, and so you can sleep at night without having to worry that this thing is going to spike to like 20 or 30 and you're going to lose all your money in your account plus more. And the most recently, I've been putting on spreads, selling call spreads at the money, sort of call spreads. So for example, right now I have one. It is the June, so 20 days to go. The June 11.5, 13.5 call spread. So essentially, this spread, which I sold for about 50 cents, if you were to look at its break-even point, if UVXY is less than 12 on expiration, I break even. If it's less than 11.5 or at 11.5, I collect the maximum amount of money for it. But if it goes above 13.5, I have the maximum loss for it. So essentially, I'm betting $4 to make 1 with a spread. That's kind of like an easy way of looking at it. So if what usually happens, I will make $1. If something really bad happens, I will lose up to $4. And so I pretty much have to put the $4 up to put this trade on. So I have to give them $4, and if everything works out right in a month, they'll give me $5 back. Or sorry, in 20 days they'll give me $5 back. So that's the kind of trade that I think is makes sense to put on in this, because you're collecting a good return, so I mean the return for this trade for me was somewhere between 15 and 25%, depending on which prices I put the trade on for over like a month. So that's a great return. The odds are in my favor, and if sort of nothing happens and it just sits right here, I will make money. And if we continue lower, I'll make money. I have contango on my side. I have the downtrend in the VIX on my side. And so I like that trade. For more information, please contact me through StockTwits or leave comments, and I can get more into it with you. And I'll be showing you more ideas in the days to come, and I'm going to bring some special guests on to do that as well. Questions, comments, concerns, please contact me on StockTwits or in the comments below. I'd love to talk to you. I'm available for people to talk one-on-one about your own trade ideas. Thanks for watching today, and we will see you next time on the Short Vol Show.